Gold seems to be the perfect investment right now because two things are true. First of all, the price, of course, long term goes up. Over the decades, it appreciates. But secondly, we are also not at an all-time high anymore. We have come down quite a bit. So is it worth it to buy the dip after we have come down from the all-time high by roughly 30%? This seems like good reasoning, but I don't think it considers all important factors. Because the reason why gold is going up is because the US dollar is going down, right? This is the whole thesis of gold. Gold being the hardest of the monies. Gold that can't get diluted away, at least not quickly. Now, this is the gold price relative to the money supply. Again, a very long-term chart. It's 66 years of data. And we can see that over the decades, gold has made a somewhat reasonable job to protect against fiat currency devaluation. But you can see from this chart that I'm not necessarily that bullish on gold. Gold has already come down, that's true, but in the past, during bear markets, it went down much more. From top to bottom, in the 1980s and 1990s, it dropped by 90% versus the monetary base. In the 2010s, it went down by 61%. I'd make the argument that gold cannot long-term keep its value versus the monetary base, and that this top is aligned with this top, that this should not just go horizontal, because that 58% decline, it can be explained entirely by the gold mining. As in, there is new gold hitting the market every year. The gold supply grows by roughly 1.6% per annum. And when we compound this over all of those years, we reach roughly those minus 58%. In other words, it's unreasonable to assume that gold can completely cancel out monetary debasement when in itself is also growing in supply, right? It can partially offset the debasement, but gold itself also loses purchasing power through the gold mining. Not at a very quick rate, just 1.6% per annum, but still it exists. Now, gold and silver are highly correlated. What we've got at the bottom, it's the silver price relative to the US money supply. It goes up at the same time, it goes down at the same time. Gold and silver, in terms of price development, even though they are two very different metals, they move in sync, as does Bitcoin and Ethereum, for example. Bitcoin and Ethereum are very different technologies, still they tend to trend in the same direction at the same time. The same is true for gold versus silver. There are other interesting similarities between gold and silver and Bitcoin and Ethereum. For example, Ethereum tends to go up at the end of a bull market in Bitcoin. So when Bitcoin has already rallied, at the end, people are looking for a more risk on investment, and then they cycle over to Ethereum. And then at some point, when everybody is super risk on, when they're also getting into the altcoins, etc., that's then when everything crashes. Now, I think the precious metals market has something very similar going on. When gold has already rallied for a while, then people are looking for the next gold, for the next opportunity that can rally even further, and that's then silver. Let me show you what I mean. So at the top, we've got the gold price relative to the money supply. And at the bottom, we've got the silver-gold ratio. How expensive is silver relative to gold? Now, I've highlighted three price spikes here. Those three price spikes happened at the end of a bull market in gold. So check this out. Silver suddenly jumped, and that marked the top of this bull market. Then over here, silver jumped again. It was very close to the top of the bull market in gold. And recently, we got another silver jump. Silver is coming back down. Gold has also followed. This silver to gold peak happened outside of a bull market. So it's not really that useful. But when we are in a bull market and then suddenly silver spikes, that tends to be a rotation towards risk on capital. At least that's what happened in the past. And every time when the silver profit had been taken, that's when we got multiple years, potentially decades of a bear market, right? That's when gold versus USM2 lost 91% over here, or in this case, it lost 62%. And it looks like history is just repeating itself again. We have seen a silver run. Now silver is selling off, even relative to gold. The risk on rotation turns into profit realization. And that's then when the momentum in precious metals turns. That's the kind of data we cannot just see on a simple dollar chart where things just go up and then retrace. because we don't know how long that retracement goes, right? The 30% retracement could have been a buying signal over here as well. But then over time, gold continued to fall and had a very, very hard time to turn around again. From here to here, it's 7 more years. Really, what matters is the performance versus the monetary base. And if that's not great, we rather look for another asset to invest in. I don't say that we have to be in fiat currency. I'm simply saying that when an asset does not outperform the monetary base expansion, we probably want to look for alternatives, because some assets definitely will. Now, how well does gold protect against a crash in the stock market? Because it does protect over many, many years, at least partially, against monetary debasement. Does it help to keep purchasing power and potentially gain purchasing power when the market crashes? Let's have a look at the numbers. So here we've got gold relative to USM2 again, and the red areas, that's when gold underperformed. During the remaining time periods, it tended to outperform. Now at the bottom, we've got the S&P 500 relative to the money supply. So there seems to be an inverse correlation here, right? When the S&P 500 is doing well, gold is not. When the S&P 500 is not doing that well, gold is doing better. It's true for this period, it's true for this period, it's true over here, and it's true over here as well. It's not true though for the last 4 years. Over the last 4 years, both gold and the S&P 500 appreciated. So a connection that used to work over the last 60 years seems to be now breaking. Now, this is not perfect, as in we have seen the stock market already coming down by roughly 30% and gold did nothing. We also saw a temporary relief rally in stocks, a 50% appreciation, while gold also appreciated. So this is no perfect inverse correlation. Gold is not just a bet on a falling price of stocks. There are times where we've got some decoupling, but it appears as if the decoupling now is stronger than it has ever been. And that then begs the question. Last time, when both the stock market and the precious metals market appreciated, we subsequently saw the stocks coming down. This was the global financial crisis here. Because of this tendency of the two asset classes moving in opposite directions, the relative valuation chart has massive magnitudes. Here is what I mean. This is the S&P 500 measured in gold. And this shows how important it is to get the asset class right. Because sometimes stock investors get wrecked relative to gold, and sometimes gold investors get wrecked relative to the stock investors. It's very important, in my opinion, to be opportunistic about what asset class to invest in. To not be dogmatic, to not just buy stocks all the time, to not just be a gold bug and buy gold all the time, to not just be a Bitcoin maximalist and buy Bitcoin all the time. There are the right times for the right asset classes. And the decision to have more allocation towards a cheaper asset class is incredibly important. Here, in the 1980s and 1990s, the S&P 500 outperformed gold by more than 3,000%. If you made the contrarian bet and you actually bought stocks when nobody wanted to have them, you got rewarded handsomely. But if you followed the stock investing crowd and you decided to buy stocks at the beginning of the 1970s, then you got crushed by the two oil crises. And then you would have been much better off buying gold. Stocks underperformed gold by more than 93% during that time period. Had you invested in gold instead of stocks during those 10 years, you'd have more than 10 times more capital. Now, it's impossible to time this perfectly, but getting this directionally right is definitely worthwhile. The problem is, of course, it's hard to figure out how this plays out long term, because there are many ways to interpret this chart. The first way is to say that maybe very long term, if we exclude dividends, the S&P 500 just trades in line with gold. That maybe there's just a long-term trading range, and currently the S&P 500 is slightly overvalued and should rather fall by roughly 36% versus gold. That's one way to interpret the data, and it's a valid way because over the course of roughly 100 years, we have not seen the S&P 500 outperform gold. But there's also an alternative explanation, because while those bottoms all align pretty well, the tops definitely don't. And so maybe the tops indicate that the S&P 500 does outperform gold long term. Maybe there is some growth. This is 258% over the course of a bit over 70 years. If that's the valid interpretation, then this would rather be the trend lines, right? We've got our aligning tops and then we've got aligning bottoms, and we just exclude this dip over here because that was an external shock. That was the oil crisis. I don't have a good answer how to interpret the ratio, if this is the right thing or this is the right thing. But what I do know is that the magnitude of those movements matter, and that all the Dave Ramseys of this world that tell you to always just buy stocks and nothing else, they are ignoring times like this. And yes, stocks do go up over the long term, but so does gold and so does everything else. It's simply just the US dollar devaluing over time. So really what matters is where should we currently allocate most of our capital toward. So when this versus this is not easy to answer, if we can't really say if the S&P 500 is slightly overvalued or slightly undervalued, then maybe there are other opportunities that are a bit more obvious. And I think there are. This is Bitcoin relative to gold. Now, Bitcoin has not performed that well over the last years. It did outperform through prior cycles, but over the last 5 years, it just traded in line with gold. As in the peak of the bull markets, they don't really produce any additional return anymore. However, there is still something positive about this chart. While Bitcoin might be already a mature market and not outperform gold that much anymore, it doesn't necessarily have to be an attractive investment now. Because when we connect all of those bottoms, we are now at a very low level. Bitcoin has fallen much more than gold, and it's currently bouncing. It's currently recovering, and it could, if it just hits the old all-time highs, outperform gold by 150% from here. Again, we want to buy the contrarian thing. We want to buy that nobody wants to buy at a particular point in time. Nobody wanted to buy stocks at the beginning of the 1980s. Nobody wanted to buy gold at the beginning of the 1970s. But that's exactly what we have to do. We have to buy the thing nobody wants to buy to get outsized returns. And currently, nobody wants to buy Bitcoin because all of the risk on capital is in artificial intelligence stocks. So Bitcoin relative to gold looks attractive. And I also think that Bitcoin relative to stocks looks attractive. This is Bitcoin relative to the NASDAQ 100. So that's a technology stock index. How much upside is there? Roughly 130%, maybe a bit more, because here we do see how the highs are still slightly growing from peak to peak. But a conservative estimate would be 130, 133%. Roughly around that level. And so yeah, I know that this is the Bitcoin strategy channel and it might look like I'm biased, that I'm just another Bitcoin maximalist. But really, when you watch prior videos on this channel, you know that I'm not always bullish on Bitcoin. Feel free to watch especially the videos at around October, November, where we were at an all-time high in Bitcoin, when I said we should rather sell. It's important to be opportunistic about investments. Bitcoin can be very profitable if it's bought cheaply. So can be gold, so can be stocks. Instead of marrying a particular asset class and always just dollar cost average into stocks, or always just buy gold, or always just buy Bitcoin, I think it's better just to ride the waves, because capital rotation is real. We know that Bitcoin relative to other asset classes can fall by 70 or 80%. But probably before this video, you did not know that stocks can fall versus gold by 94%, or that gold relative to the monetary base can fall by 91%. Every investment is risky. And of course, the most risky of them all is fiat currency. We have to get out of fiat currency. Fiat currency devalues over time by 6.8% per annum. We have to get out of it. The question is only, what do we get our money into? And really, this should not just be one single asset class all the time. It should be the asset class that's currently comparatively cheap. And I think over the next years, maybe 1, 2, 3 years, Bitcoin is probably going to outperform gold and technology stocks, simply because they have already run quite a bit and Bitcoin has sold off a lot. If it's your first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. Feel free to also check out the premium membership. This is where you can co-invest alongside with me. That pops up over here on the screen. So see you next time. Cheers.